Disclaimer.
Gold just lost $1.8 trillion in market value in a single hour, and silver plummeted 13.8% from its record high. But if you think this is a crash, you're reading the wrong map. While American retirement accounts are panic selling into the Friday massacre, the central banks of the East are paying 100% premiums to strip the world's vaults bare. Today's nomination of Kevin Warsh didn't just change the Fed, it ended the 17-year safety net for your savings. We have entered the unfed era, a 90-day window where the paper price discovery mechanism is breaking, and the path to $150 silver is being paved with the ruins of the dollar. Monday morning is the deadline. Are you positioned, or are you the liquidity? Let me show you exactly what happened this morning, because the story you're hearing on CNBC isn't the real story. At 9:34 a.m. Eastern Time on January 30th, 2026, the Trump administration made an announcement that sent shockwaves through every precious metals portfolio in America. Gold crashed 5.8% from yesterday's all-time high of $5,608 per ounce. Silver got absolutely demolished, dropping from its record $117 to $99 in less than 3 hours of trading. We're talking about the fastest single-day collapse in precious metals since the pandemic panic of March 2020. But here's what makes this different from every other market sell-off you've experienced. This wasn't triggered by some unexpected economic data or geopolitical crisis. This was a deliberate political choice that just rewrote the rules of our entire financial system. Kevin Warsh just got nominated to chair the Federal Reserve. Now, if you're thinking, who cares about another Fed appointment? You're missing the biggest shift in American monetary policy since Paul Volcker broke inflation back in the early 1980s. Because the traders who dumped $5 billion worth of gold and silver futures in the first hour after the announcement, they understand something most Americans haven't grasped yet. We just entered what financial insiders are calling the unfed era, and the safety net that's protected our markets for 17 years is about to be ripped away. Let me take you back to November 2025, just 2 months ago. Donald Trump is assembling his economic team, and the precious metals community is absolutely euphoric. The narrative seemed airtight. Trump hates Jerome Powell. Trump wants lower interest rates. Trump will appoint someone who will weaken the Fed's independence and flood the system with cheap money. Gold bugs and silver stackers poured billions into metals, betting that a weakened Federal Reserve meant inevitable currency debasement. They pushed gold to $5,600 and silver to $117, convinced they were getting ahead of the biggest monetary expansion in American history. Then Trump nominated the one person who represents the complete opposite of everything those investors believed. Kevin Warsh isn't just hawkish on inflation. He's the man who resigned from the Federal Reserve Board in 2011 specifically because he opposed Ben Bernanke's quantitative easing programs. His resignation letter, which you can still read in the Federal Reserve's public archives, laid out a scathing critique of the very policies that created the 17-year bull market in stocks, bonds, and real estate. According to Warsh's own writing from that period, the Fed had abandoned its core mission and transformed into a price-fixing mechanism that distorted every market signal in our economy. Here's where the betrayal narrative gets really interesting. Those Trump supporters who loaded up on precious metals thought they understood the president's playbook. Trump tweets constantly about how Powell's interest rates are too high, how we need cheaper money to boost growth, how the Fed is standing in the way of American prosperity. So naturally, everyone assumed his Fed pick would be someone who'd cave to political pressure and cut rates aggressively, someone who'd keep the money printer running and protect asset prices no matter what inflation did. Instead, Trump just nominated the guy who wrote a Wall Street Journal op-ed in November 2025 titled The Federal Reserve's Reckoning. In that piece, which ran just 6 weeks before today's announcement, Warsh systematically dismantled Jerome Powell's entire framework. He argued that forward guidance, the practice of telegraphing future rate moves to calm markets, had turned the Fed into a hostage of Wall Street expectations. He claimed the Fed's balance sheet, still bloated at over $7 trillion from COVID-era bond purchases, represented the greatest moral hazard in financial history. And most critically for precious metals investors, he stated explicitly that the so-called Fed put, the market's belief that the central bank will always step in to prevent major crashes, needed to be destroyed for capitalism to function properly. Think about what that means for your retirement account, your home equity, your investment portfolio. For 17 years, ever since Ben Bernanke started slashing rates in response to the 2008 financial crisis, we've lived in a world where the Federal Reserve acted as the ultimate backstop. Stocks falling too fast, Fed cuts rates, credit markets freezing up, Fed buys bonds, banks in trouble, Fed opens emergency lending facilities. This framework became so embedded in investor psychology that an entire generation of traders has never experienced a true free market crash without immediate Fed intervention. Warsh just announced in the clearest possible terms that the safety net is coming down. But here's where the confusion reaches almost comical levels. The same Kevin Warsh who quit the Fed over excessive monetary stimulus, who spent the last 14 years writing academic papers about the dangers of central bank intervention, has now made multiple public statements supporting Trump's demand for lower interest rates. In a December 2025 interview with CNBC, Warsh said current Fed policy might be too restrictive for optimal growth. In a January 2026 speech at the Economic Club of New York, he suggested that benchmark rates above 4% might be unnecessary, given productivity improvements from artificial intelligence. So, which Kevin Warsh are we getting? The purist who resigned on principle in 2011, or the political pragmatist who's signaling flexibility in 2026? This isn't some academic question for economics professors to debate. Markets need to price risk, and right now they literally cannot figure out what policy regime we're entering. Are we heading into an era of radical Fed tightening that deliberately crashes asset bubbles? Or are we getting a Powell replacement who will cut rates despite above-target inflation to satisfy presidential demands? The professional traders who move billions of dollars across global markets made their choice this morning. They sold everything until the confusion clears. Gold and silver bore the brunt because they're the purest plays on Fed policy uncertainty. If Warsh tightens aggressively and strengthens the dollar, precious metals get crushed. If he caves to Trump and cuts rates despite inflation risks, precious metals eventually soar but might fall first as the policy credibility collapse unfolds chaotically. What's creating the most anxiety among Fed watchers is Warsh's track record from his previous stint on the Board of Governors between 2006 and 2011. According to Federal Reserve meeting transcripts that were released under the standard 5-year delay, Warsh consistently argued against stimulus even when unemployment reached 10%. In a September 2009 meeting, with millions of Americans losing their homes to foreclosure, Warsh warned about phantom inflation that hadn't shown up in any data yet. He opposed additional bond purchases in 2010 when GDP growth was barely positive. His entire framework seemed built around fighting inflation that existed only in economic models, not the real world where families were struggling to find work. Now fast forward to January 2026. We've got 3.5% inflation, which is above the Fed's 2% target, but nowhere near crisis levels. We've got unemployment at 4.1%, which represents essentially full employment. We've got an economy that most metrics show is actually overheating slightly, with consumer spending stronger than anyone expected and corporate profits at record levels. By any historical standard, this is exactly the environment where the Federal Reserve should be keeping rates steady or even raising them to prevent bubbles from forming. But Trump wants cuts. And Warsh, despite his entire professional history suggesting he'd resist political pressure, has made statements that suggest he might accommodate those demands. Can you see why markets are panicking? This isn't about whether interest rates go up or down by a quarter point. This is about whether the Federal Reserve maintains any independence at all, or whether it becomes a political tool that responds to whoever controls the White House. If Warsh cuts rates aggressively despite economic conditions not warranting it, he destroys the Fed's credibility as an inflation fighter. If he refuses Trump's demands and tightens policy, he triggers a political confrontation that could fundamentally reshape how our central bank operates. Either path leads to chaos, just different flavors of it, and in the 60 to 90 days it takes for the Senate to confirm Warsh's nomination, we are stuck in this bizarre twilight zone where Jerome Powell is a lame duck chairman with no real authority, Trump is attacking Fed policy daily on social media, and nobody actually controls monetary policy. Senator Tom Tillis has already announced he's blocking any confirmation vote until the Department of Justice completes its investigation into Fed trading practices, which could extend this vacuum even longer. The gold and silver crash you're seeing right now, that's not investors making a judgment about where precious metals should be valued. That's the market putting a giant question mark over the entire foundation of American monetary policy and deciding to sit in cash until someone, anyone, provides a clear answer about what comes next. Because the framework that governed our financial system since 2008, the unspoken agreement that the Fed would always step in to prevent catastrophe, just got nominated for demolition. And we're all about to find out whether the safety net was protecting us from disaster or preventing the market from functioning properly in the first place. But here's what Wall Street doesn't want you to understand about this morning's price collapse. While American investors were panic selling their silver ETFs and gold mining stocks, something extraordinary was happening 8,000 miles away in Shanghai. Chinese buyers were paying double the COMEX futures price to get their hands on physical metal. Not 10% more, not 20% more. They were paying a 100% premium over the paper price to secure actual silver bars that they could touch and store. That's not a market correction. That's a market screaming that paper prices have completely disconnected from physical reality. Let me paint you a picture of what's actually happening in the real world of metal that exists outside the computer screens where futures contracts trade. According to the World Gold Council's January 2026 report, global silver inventories dropped by 230 million ounces in 2025. Now, 230 million ounces might sound like just another statistic, but let me put that in perspective for you. Total worldwide mine production in 2026 was approximately 835 million ounces. That deficit represents 14% of everything that came out of the ground last year, simply vanishing from available supply. Where did it go? It didn't evaporate. It got manufactured into solar panels that will sit on rooftops for 25 years. It got embedded into electric vehicle components that won't be recycled for a decade. It got turned into circuit boards for AI data centers that are being built across America right now. Once silver enters industrial applications, it's economically unrecoverable. The amount of silver in a single solar panel is worth maybe $8, but the cost to extract and refine it back to pure form would be $30. Nobody's doing that math and deciding to start a recycling business. The London Bullion Market Association, which tracks the world's largest precious metal storage facilities, published data last week showing their vaults are now at 2015 levels. Think about what that means. In 2015, we didn't have a global solar boom requiring 120 million ounces per year. We didn't have electric vehicle production consuming 70 million ounces annually. We didn't have artificial intelligence creating unprecedented demand for silver-based cooling systems and server components. Yet, despite demand being exponentially higher than it was 9 years ago, available inventory is back to where it was when demand was a fraction of current levels. The Shanghai Futures Exchange reported inventory levels this month that represent the lowest stockpiles since they started publishing data in 2008. We're talking about less than 6 months of global industrial consumption sitting in all the world as exchange-registered warehouses combined. 6 months. And remember, that's not 6 months of total demand. That's just industrial demand, not counting investment demand, jewelry fabrication, or any of the other ways silver gets consumed. Now let's talk about what happened on January 1st, 2026, exactly 4 weeks ago. China implemented new export licensing requirements for silver that completely restructured the global supply chain overnight. According to Reuters, reporting from early January, approximately 80% of Chinese silver exporters lost their licenses under the new regulatory framework. The official explanation from Beijing's Ministry of Commerce cited strategic resource management and environmental compliance standards, but the effect is crystal clear. China just cut 120 million ounces from global export markets, representing roughly 15% of world supply. Think about the implications of that for a moment. You're a solar panel manufacturer in Germany, or an automotive parts supplier in Michigan, or a semiconductor fabrication plant in Arizona. You've built your entire production schedule around receiving regular silver shipments from Chinese refiners who've been reliable suppliers for 15 years. On January 2nd, those suppliers sent you emails explaining they no longer have export licenses and cannot fulfill your contracts. What do? You start calling everyone else who might have silver. You offer to pay whatever price necessary to keep your production lines running. That's exactly what's happening right now, and the premium structure tells the whole story. Physical silver in China is trading at premiums of 100% over the COMEX futures price. That means if paper silver on the futures exchange shows $99 per ounce, actual physical metal in Shanghai is changing hands at $198. In Japan, according to the Tokyo Commodity Exchange, premiums hit 60% last week. In Dubai, which serves as a major trading hub for the Middle East, premiums reached 40%. Meanwhile, the paper price on COMEX crashed 13.8% this morning. Can you see the complete disconnect? The paper market, where traders bet on price movements using contracts that rarely result in physical delivery, is showing one reality. The physical market, where actual metal changes hands to supply real industrial demand, is showing a completely different reality. And the gap between these two realities is widening by the day. Let's talk about why industrial demand is so inflexible, because this is crucial to understanding why we're heading toward a crisis that no Fed policy can prevent. When Tesla builds an electric vehicle, that car requires approximately 1 kilogram of silver distributed across dozens of components. The silver is in electrical contacts, in circuit boards and battery management systems, in charging infrastructure. You can't substitute it with copper or aluminum or any other metal because silver has unique electrical and thermal conductivity properties that make it irreplaceable for high-performance applications. Now, Tesla isn't sitting around watching silver prices and thinking, maybe we'll build fewer cars if silver hits $120 per ounce. They've got factories running 3 shifts. They've got workers on payroll. They've got dealerships waiting for inventory. They've got quarterly production targets that Wall Street is tracking. The silver cost in each vehicle is maybe $200 worth of material. If silver doubles in price, that adds $200 to a $50,000 car. Tesla will pay it, pass the cost along to consumers, and keep the production line moving. The solar industry faces an even more dramatic situation. According to the Solar Energy Industries Association, installations planned for 2026 will require between 120 and 125 million ounces of silver. These aren't speculative projects that might happen if conditions are favorable. These are contracted installations with signed agreements, financing already arranged, construction crews scheduled, and in many cases, government subsidies tied to completion deadlines. A typical commercial solar installation uses about 20,000 ounces of silver. Once that silver is bonded into photovoltaic cells and installed on a warehouse roof, it's there for 25 years minimum. It's not coming back into supply when silver hits $150 or $200 or any other price point. The artificial intelligence boom is creating a demand category that didn't even exist 5 years ago. Every AI data center requires massive amounts of silver for server cooling systems, for high-speed data connections, for power distribution infrastructure. Microsoft, Amazon, Google, and Meta are building these facilities across America right now, investing hundreds of billions of dollars in AI computing capacity. According to the Silver Institute's 2026 industrial demand forecast, AI infrastructure will consume between 15 and 20 million ounces this year. That number is projected to grow by 25% annually as the AI race accelerates. Here's what you need to understand about this industrial demand. It's not price sensitive in the way investment demand is. When silver crashed from $117 to $99 this morning, not a single automotive executive or solar company CEO or data center operator canceled their silver orders. They need the metal to keep their businesses operating, and the cost of silver is a tiny fraction of their total project budgets. They'll pay $100 per ounce, or $150 per ounce, or $200 per ounce, because not having silver means shutting down production lines that cost millions of dollars per day to operate. Meanwhile, investment demand just evaporated. American investors dumped their silver ETF holdings, sold their mining stocks, liquidated their futures positions. That's the selling pressure that created this morning's price collapse. But those investors aren't the marginal buyers who will determine where prices go from here. The marginal buyers are the industrial users who have no choice but to secure physical metal regardless of price, and they're competing for a shrinking pool of available supply. The Bank for International Settlements published a study last month examining commodity market structure, and they identified something alarming in the silver market specifically. The ratio of paper claims to physical metal has reached historic extremes. For every ounce of silver that actually exists in COMEX registered vaults, there are approximately 250 ounces worth of futures contracts outstanding. This works fine as long as everyone treats silver futures as a financial instrument for price speculation, not as a claim on actual metal. But what happens when industrial users who are desperate for physical supply start demanding delivery instead of rolling their contracts forward? What happens when the Chinese manufacturers who lost export licenses start buying COMEX futures and demanding the physical metal be shipped to Shanghai? What happens when the paper price becomes so disconnected from physical reality that arbitrage traders start buying futures at $99, demanding delivery and selling the physical metal in Asia at premium prices? You get a delivery crisis. You get a situation where the exchange has to suspend trading, or change settlement rules, or admit that they've sold claims on metal that does not exist in sufficient quantities to satisfy demand. And once that credibility breaks, once the market realizes that paper silver and physical silver are truly different assets trading in different universes, the catch-up repricing is going to be spectacular. That's what the 100% premiums in China are telling you. That's what the 6 months of inventory at historic low levels is telling you. That's what the 230 million ounce deficit is telling you. While American investors are focused on Fed policy and interest rates and what Kevin Warsh might or might not do, the physical metal market is quietly setting up for the supply crisis of the decade. And it's happening right now, in real time, while paper prices are crashing and creating what might be the last chance to acquire physical silver before the disconnect becomes so obvious that premiums make it unaffordable for regular people. Now here's where this story gets really interesting, because everyone's trying to figure out which way Kevin Warsh will jump once he takes the chair in May. Will he be the inflation hawk who resigned in 2011, or will he be the political pragmatist who bends to Trump's rate cut demands? The financial media is treating this like it is the critical question that will determine whether precious metals soar or crash. But what if I told you it doesn't actually matter which personality shows up? What if both roads lead to the exact same destination, just at different speeds? Let me walk you through road number one, the scenario where Trump wins and Warsh bends to political pressure. Imagine it's June 2026, Warsh has been confirmed for a month, and Trump is tweeting daily about how our economy needs lower rates to compete with China. The pressure is enormous. Republicans in Congress are echoing the message. Fox Business is running segments about how 3.5% inflation isn't that bad and we need growth. And Warsh, despite everything he wrote in his 2011 resignation letter, decides that maintaining his position at the Fed matters more than maintaining his principles. So he cuts. Maybe 50 basis points in June, another 50 in July. He signals to markets that more cuts are coming despite inflation still running above the 2% target. Maybe he doesn't call it capitulation. Maybe he frames it as responding to productivity gains from artificial intelligence, or adjusting policy to new economic realities. But the market sees through it immediately. The Federal Reserve, the institution that's supposed to be the independent guardian of currency stability, just became a political tool that responds to presidential tweets. What happens to the dollar when that credibility evaporates? International holders of U.S. Treasury bonds who've been nervous about our spending trajectory for years start asking themselves a very simple question. Why are we lending money to a country whose central bank will print whatever amount is necessary to satisfy political demands? The Japanese government pension investment fund, which holds over $1 trillion in U.S. assets, has a fiduciary duty to protect the purchasing power of future retiree benefits. If the Fed demonstrates it will debase the currency for political reasons, what's the rational response? They sell. Not all at once, because you can't dump $1 trillion overnight without destroying your own position. But gradually, methodically, they start rotating out of U.S. dollar assets and into alternatives. The Chinese do the same thing. The Saudis, who've been making noise about diversifying away from the petrodollar for 2 years now, accelerate their plans. And suddenly, the dollar isn't just falling gradually, it's in a genuine crisis of confidence. Treasury yields spike because foreign buyers are disappearing, and the Fed can't raise rates to defend the currency, because that would contradict the whole rate-cutting campaign they just started. The 10-year Treasury, which is the benchmark for everything from mortgage rates to corporate borrowing costs, starts approaching 6%, then 7%. The federal government's interest expense, already consuming over $1 trillion annually at current rates, becomes completely unsustainable. We're talking about a debt spiral where higher rates increase the deficit, which requires more borrowing, which pushes rates even higher. In this scenario, gold breaks above $5,600 and keeps climbing through the summer of 2026. It hits $6,000 in July, $6,500 in August, and by September, it's trading above $7,000 as the world collectively decides that the US dollar is no longer a reliable store of value. Silver, which always amplifies gold's moves because of its smaller market size, explodes past $120 by the end of June. By the third quarter, we're looking at $150. And anyone asking whether it can go higher is missing the point. Once currency debasement becomes the explicit policy, there's no ceiling on hard asset prices denominated in that debasing currency. Your retirement account that's denominated in dollars? It might show bigger numbers, but what can those dollars actually buy? Your home equity? Sure, the nominal value goes up, but so does everything else, and if you're on a fixed income or your wages aren't keeping pace, you're getting poorer in real terms even as your net worth on paper looks impressive. This is the fast route to $150 silver, the road number one scenario where Fed credibility collapses, and we get there by the end of the third quarter in 2026. Now let's explore road number two, which looks completely different on the surface, but lands at the exact same destination through a more circuitous path. In this scenario, Kevin Warsh takes the chair in May 2026 and decides he's going to be the Paul Volcker of his generation. He's going to restore Fed independence, rebuild credibility, and prove that central banks can still make hard choices even when politically unpopular. Trump is tweeting furiously demanding cuts, but Warsh holds rates steady. Maybe he even hints at future increases if inflation doesn't moderate toward the 2% target. Wall Street initially panics because the Fed put is truly dead. Stock market volatility spikes. Corporate bonds start selling off because higher for longer rates mean lower valuations for growth companies and higher refinancing costs for leveraged businesses. Real estate developers who have been floating projects with the assumption of declining rates suddenly face a world where money stays expensive indefinitely. But Warsh doesn't blink. This is his moment to prove that the Federal Reserve can function as an independent institution. At the same time, Warsh begins shrinking the Fed's balance sheet more aggressively than Powell ever dared. Remember, the Fed is still holding over $7 trillion in bonds purchased during COVID and the 2008 crisis. Warsh starts letting those bonds mature without replacing them, effectively draining liquidity from the financial system. This is called quantitative tightening, and it has the opposite effect of the money printing that gold bugs have been warning about for years. Here's where it gets tricky. The U.S. Treasury Department is issuing record amounts of new debt to fund our ongoing deficits. In fiscal 2025, according to the Congressional Budget Office, we ran a $2 trillion deficit. That means Treasury needs to find buyers for $2 trillion of new bonds, plus whatever amount of existing bonds are maturing and need to be refinanced. That's roughly $6 trillion of total issuance that needs to be absorbed by private markets. Now imagine you're a bond trader in August 2026. The Fed is actively shrinking its balance sheet, which means they're not buying Treasury bonds anymore. They're actually net sellers as their holdings mature. Foreign buyers are scaling back because they're nervous about our political dysfunction. Insurance companies and pension funds, the traditional large-scale bond buyers, are already fully allocated, and Treasury is trying to dump $6 trillion of bonds into this market. What happens when supply vastly exceeds demand? You get September 2019 all over again, except much worse. In September 2019, overnight lending rates in the repo market suddenly spiked from 2% to 10% in a single day because there wasn't enough liquidity in the system. Banks were scrambling to meet their reserve requirements, and there weren't enough lenders to satisfy demand. The Fed had to conduct emergency operations, injecting billions of dollars into the system to prevent a complete seizure of credit markets. Now imagine that crisis, but multiplied by the fact that the Fed's balance sheet is shrinking instead of expanding. Treasury issuance is double what it was in 2019, and international buyers are scaling back their participation. You get a liquidity crisis that makes 2019 look like a minor technical glitch. Overnight rates spike to 15%, maybe 20%. Banks can't fund their basic operations. The commercial paper market, which corporations rely on for short-term financing, simply stops functioning. Companies with perfect credit ratings can't borrow money to make payroll. This is the point where Kevin Warsh, despite all his hawkish rhetoric, despite all his principled stands about Fed independence, faces a choice that isn't really a choice at all. Does he watch the Treasury market collapse and take the entire financial system down with it? Does he maintain his hawkish posture while credit markets freeze and the economy slides into a deflationary depression? Or does he do exactly what Ben Bernanke did in 2008? What the Fed always does when markets seize up. He floods the system with liquidity on a scale that makes previous interventions look tiny by comparison. In this scenario, we get emergency quantitative easing that dwarfs the COVID response. The Fed does not add $2 trillion to its balance sheet like they did in 2020. They add $4 trillion, $5 trillion, whatever number is necessary to unfreeze credit markets and restore Treasury market functioning. Because here's the dirty secret about balance sheet reduction and hawkish Fed policy. It only works until it doesn't. And when it breaks, the policy reversal has to be even more dramatic than the tightening that preceded it. So picture yourself as a silver investor in September 2026 under this road number 2 scenario. Silver bottomed at $99 back in January when Warsh got nominated. It might have drifted lower over the summer as the hawkish Fed policy strengthened the dollar and squeezed commodity prices. Maybe it touched $90 in August, and everyone was calling you crazy for not selling back at $117. The financial press is writing obituaries for precious metals, explaining why hard assets are obsolete in a high interest rate environment. Then the repo crisis hits. Treasury yields spike to levels that threaten government solvency. Credit markets seize, and Warsh announces emergency measures that make Jerome Powell's COVID response look restrained by comparison. Within 90 days, silver isn't at $90 anymore. It's not even at $120. We're looking at $150 and climbing, because the market just learned that no matter how hawkish the Fed talks, when the system breaks, they will always choose inflation over deflation. They will always print money rather than allow a deflationary collapse. That's road number 2. It takes longer than road number 1. It's more painful to live through if you're holding physical metal during the summer swoon, but it gets you to the same destination. $150 silver becomes the floor, not the ceiling, because the emergency QE required to fix a full-blown crisis is always larger than the gradual accommodation of road number 1. Now, let's talk about the 60 to 90-day window we're in right now, because this is where opportunity meets preparation. Kevin Warsh won't be confirmed until at least late April, possibly as late as May, depending on how long Senator Tom Tillis blocks the vote. That means we have 2 to 3 months where Jerome Powell is a lame duck chairman with no real authority. He's not going to launch any bold policy initiatives or make dramatic changes when everyone knows he's on his way out. Trump is attacking the Fed daily on Truth Social, undermining whatever remaining credibility Powell might have. And Warsh hasn't taken office yet, so he can't implement policy either. We're in a genuine policy vacuum. Nobody is in charge of American monetary policy at the exact moment when industrial silver demand is at record levels. Exchange inventories are at decade lows. China has cut off 15% of world supply, and the paper price just crashed 13.8%, creating the biggest arbitrage opportunity in precious metals history. This is what professional traders call the eye of the storm. It's the brief, calm period between the initial shock and the real chaos that's coming, and it's when physical premiums go absolutely wild. According to dealers I've spoken with in the last 6 hours, premiums on American Silver Eagles have already jumped from $3 per coin yesterday to $8 per coin this afternoon. That's before Asian markets even open tonight, before Chinese and Japanese buyers wake up to see the crash and start placing orders. By next week, retail premiums in the United States could hit 40% or 50% over spot price. By February, we might be looking at 100% premiums like China is already paying. Because here's what happens when paper prices crash, but physical supply remains tight. The industrial users who need metal don't stop buying. The Eastern central banks who want to diversify from dollars don't stop buying. And the retail investors who understand the supply crisis don't stop buying. The only sellers are paper traders who never wanted physical metal in the first place, and their selling pressure impacts futures contracts, not actual bars and coins changing hands in the real world. This is your window, not next month when everyone else has figured it out. Not after Warsh gets confirmed and markets have clarity on which road we're taking. Right now, this weekend, Monday morning when dealers opened, and you can still buy physical metal at prices that bear some relationship to the paper market. Because whether we get road number 1 or road number 2, whether it's fast currency debasement or slow deflationary crisis followed by explosive reflation, the end point is identical. $150 silver becomes the baseline, not the peak. Gold retakes 5,600 and pushes towards 7,500. And the people who positioned themselves during the Friday massacre while everyone else was panicking, they are the ones who look back at $99 silver the way people look back at $300 gold in the year 2000. The map is clear now. The paper price discovery mechanism is breaking in real time. The physical market is separating from the futures market. And you have maybe 72 hours before the rest of the world catches up to what the Eastern central banks already know. Are you positioned or are you the liquidity?